Hi everybody, this is Ellman, the blue collar investor, and today we're going to discuss a plan to get rich slowly and to retire young. And this is a little different than what you normally hear from me where we talk about stock options. This is a plan geared to students and to everybody that's not near retirement. Now, we're going to start with a question. Why should we invest in stocks? Well, historically, stocks have generated higher returns than bonds, than real estate, and certainly more than savings accounts. Historical returns in the stock market range from 8 to 10% depending on the time frame that we're looking at. In our wealth building portfolio, we're going to use the lower amount, the 8% return, when we're doing our calculations. And this plan really is all about income. Now, to get started, we're going to need $1,000. Students, that may be something you have to take time to save up for. For many others, you may already have this amount or more. This is a plan that can be adjusted to your particular situation and your particular needs. But the assumptions we're going to make here is that we're going to start with $1,000 and that in this 40-year plan, which we're going to start at the age of 18, with a goal of retiring a millionaire by the age of 58. Again, this plan can be adjusted to your particular situation. We're going to assume that the first 20 years of this 40-year plan, the average annual gross income is $60,000. And for the second 20 years, the average annual gross income will be $80,000. Now, active income is the income that you actually have to go to work for and generate a paycheck every single week. Passive income, which is what we're talking about here in our wealth building plan, is where we use a certain percentage of the income generated from the active income and use that income to create a second income stream called the passive income. And that's what we're going to be honing in on in today's video. Portfolio diversification is important, not only within the stock portion of our portfolio, but in our overall portfolio. So suffice it to say, you should also have a real estate presence, which for most of us is owning a home, and we should have some cash equivalents in case of emergencies also within our portfolios. Again, we're going to zero in now on the stock portion of our overall portfolio. And we're going to be using two types of securities. Initially, we're going to be using mutual funds. And then once our portfolio value reaches $25,000, we're going to move over into individual stocks. So let's start off with what exactly is a mutual fund. Well, it's an investment that's made up of a pool of funds collected from investors just like you and me. And what the money managers do is they try to invest this money and create capital gains and income for the investors. Now, the portfolio is structured to match the investment objectives stated in the prospectus. Now, what we're going to do is we're going to use a passively managed mutual fund that's an index fund geared to the broad market index, like the total stock market or the S&P 500. So the money managers really have very little to say because the stocks within the mutual fund must match those in the broad market index. Now, once we have generated $25,000 cash value in our portfolio, we're then going to move from mutual funds into individual stocks, which will generate higher returns. Now, a stock really just is ownership in a particular corporation that entitles us to a portion of the corporation's assets and profits. So again, once the portfolio reaches $25,000, we're going to move into stocks. So let's talk about how we're going to select those stocks. And it's a three-pronged selection process, which is going to be made very, very easy for you because it's going to be automated. We're going to have descriptive rules. We're going to have certain fundamental requirements and certain technical requirements. Let's start off with the descriptive rules. As you could see here on the screenshot, that will only accept stocks that are priced $15 or more, that have a market capitalization of $2 billion or more. And a market capitalization is simply the price per share times the number of outstanding shares. So in essence, we're going to be dealing only with solid blue chip corporations to build our portfolio and allow us to become a millionaire and retire young. We also want our stocks to have average daily trading volume of 500,000 shares or more per day. So our stocks will be highly liquid, giving us favorable pricing when we're buying and selling our stock. And everything is going to be fed into an online stock screener. The free screener that I talk about in my book, which I'll be showing you later on, is finviz.com. It's a great screener, and all you have to do is feed in our requirements, our descriptive requirements, our fundamental requirements, and our wealth building requirements, and the screener will generate a watch list to select our stocks from. As far as fundamental requirements, this deals with the financial health of the corporation. And we have certain ratio requirements like a PEG ratio of 2 or less and return on equity of 15% or higher. This information is all detailed and described in the book, but basically all you have to do is feed it into the online screener, which you see here right in front of you. And you could see we fed in descriptive and fundamental terms. We'll get to the technical in just a moment. You could see on the lower left the descriptive term, over $15 a share, and you could see on the top left that the price to book, P/B, under 4, and so on. So I give you all the parameters. You feed them into the screener, and the screener will provide you with a watch list of stocks to select from. As far as the technical requirement, this has to do with the price chart. We want to see those prices accelerating, moving up, with the shorter term 50-day simple moving average above the longer term 200-day simple moving average. All that means is that we want our more recent prices to be higher than the older prices. We want an uptrending technical chart. And again, this is, you don't have to start drawing charts here, just fed into the screener with the current price above the 50-day simple moving average and the 50-day simple moving average above the 200-day simple moving average. Just feed it into the screener. The screener will develop a watch list for us. So why do we favor mutual funds to begin our journey creating a wealth building portfolio and allowing us to retire a millionaire at a young age? Well, mutual funds, as opposed to exchange traded funds, which are stocks that behave like mutual funds that behave like stocks, we favor mutual funds because they could be purchased by automatic withdrawal. So we just set it up with our broker. For example, if you're earning $12,000 in the first year, that means you're going to invest 10% of that, or $1,200. That could be broken down into $100 a month. You will instruct your broker to purchase $100 every month of the mutual fund, and it can be purchased fractionally. So whatever the price per share is, you divide it into 100, and that is the number of shares that you purchase that month. Once again, we're going to use a broad market index fund like the S&P 500 or the total stock market that have very low expense ratios. That means low administrative fees. I make certain recommendations in the book that I'm going to show you in just a few moments. And these can usually be purchased for 0 trading commissions, another benefit of using these mutual funds. So here are our game plan assumptions per family. And again, these can be adjusted to your particular situation and your particular needs. We're going to start at the age of 18 with a goal of retiring a millionaire by the age of 58. Write this goal down and put it where you could see it every single day, perhaps adjacent to your computer. We're going to have an initial investment of $1,000, which will allow us to open up a brokerage account. And we're going to invest 10% of our gross annual income each year. The assumption being the first 20 years we're going to average $60,000, and the second 20 years we're going to average $80,000, and we're going to be investing 10% of those statistics, or $500 a month in the first 20 years and $666 a month for the second 20 years. We're going to use the lower historical figure for returns on the stock market of 8%. So if we feed this into a compound savings calculator, which you could find at bankrate.com, the first 20 years, you could see we started with 1,000, 20 years, 500 a month, and that will give us an average return of 8%. And 8% reinvested, dividends and such, and profits means that after 20 years, our investment will grow to $299,400. Now, for the second 20 years, you recall, we're going to make the assumption that you're going to average an annual income of $80,000 and invest $8,000 a year, or $666 per month, and once again at the rate of return of 8%. And as you can see here on the graphic, the $299,400 will then grow to $1.8 million after the 40-year total. So that will allow us to become a millionaire and retire young by the age of 58 with these assumptions. Now, as far as the wealth building rules for stocks, very important to manage our positions with individual stocks. So make sure your brokerage trading platform allows for what's called trailing stop loss orders. That means we're going to instruct our broker to sell a stock if it drops by 10% from its highest point. So there's no resistance on the upside, but we are protecting the downside by instructing our broker to sell if the price of the stock drops by 10% from its highest point. If that happens, automatically the shares will be sold, cash will be in our account, we go to our stock screener to find another candidate to replace that particular stock. So this will give us protection and allow us to keep our profits. We must use an online discount broker so that trading commissions are very low, and we use this in a cash account, not in a margin account. In other words, we're not going to be borrowing any money from our broker. We're just going to be spending what we've earned and what our plan has developed in terms of cash value. So we're going to be using a lot of very accepted financial rules and regulations as it relates to our wealth building portfolio. One of them is dollar cost averaging. We talked about that, where we invest a certain amount of money every month to purchase our mutual funds. That will eventually turn into purchasing stock once our portfolio value reaches $25,000. Asset allocation: no one stock or industry should represent more than 20% of our stock portion of our portfolio. And in a broader sense, our total portfolio should also include some cash and some real estate, and perhaps even some bonds. And at the end of the year, we'll do portfolio rebalancing so that no one position can dominate the others. So if a position has grown a lot with one particular stock, we will sell off some of the shares and put it in some of the other positions, so we have an equal amount of cash allocation in each position. Position management, again, that's automated. We're going to use the 10% trailing stop loss order. Make sure your brokerage platform will allow for this. Shares will be sold if they drop by 10% from their highest point, and that's how our positions are managed automatically. And we're going to reinvest our dividends, reinvest our profits. This is called compounding. And folks, that's the eighth wonder of the world, and that's what's going to allow you to become a millionaire and retire at a young age. Here's the book that details the plan. It's called Stock Investing for Students, but it's applicable to everybody not near retirement. This book can be found on my website, thebluecollarinvestor.com/store, and it can also be found on Amazon.com. So there you have it, a plan to get rich and to retire young. Stock investing for students or anybody not near retirement. So thank you so much for watching this video. I really hope you benefit from it. I really hope you could become a millionaire and retire young. Use the principles that we discussed and you will get there. As always, this is Ellman, the Blue Collar Investor, thanking you for watching this video. Take care, everybody.